Good morning. Mark Ostwald from ADM Investor Services International with some thoughts on China, its inflation rate, and above all the big debate about what it's actually actively or not actively doing with its currency at the moment. So we've had today the Chinese inflation data, and they're very much a mixed bag with producer prices dipping into deflationary territory at -0.3 for the first time since May of 2016, so August 2016. The CPI inflation numbers, on the other hand, are a very divergent story and tell us a big story about China's economy at the moment, I think, which is well worth noting. First of all, if we have a look at this chart, you've got the yellow line, which is the overall inflation rate, which ticked up to 2.8. But what one can see there is it's being driven all by food prices. That's a combination of Asian swine fever effects driving up pork prices, which are a huge component of Chinese CPI, and indeed fruit prices, which are up also in the region of about 30% due to bad weather. Otherwise, really, the underlying inflation measures, i.e. non-food prices and indeed core CPI, are trending into the sort of territory where one might expect the People's Bank of China to ready a rate cut, which is something which rate moves are very, very infrequent in China. Generally, they tend to be all about liquidity moves. But so a rate move obviously would put some downward pressure, one would think, on the Chinese exchange rate. But let's have a look at the next chart, which is I think the big point of debate. Obviously, we gapped higher to start the week with the imposition or the threat of the imposition of additional tariffs from the US. And there was this expectation that China was actually devaluing its currency. Now, we are focused as a market always on the dollar-yuan exchange rate, probably because that's what we're used to, and also because Mr. Trump is so focused on it. But the truth of the matter is what they actually target is something called the CFETS index. They've been targeting that since the beginning of since 2014. And that particular index, basically, at the moment, really what one has to really understand is the weakness that we're seeing in the yuan isn't actually a function of devaluation. If we go to my next table, this shows the makeup of the CFETS index. And in that, what you will see is, amongst others, two of the weakest currencies that we've seen around this year, the Korean won, which is the yellow section on there, the big yellow 10.8% section, and the Australian dollar 4.4, also. So basically, all China's really doing is following the weakness of what's going on elsewhere. So this isn't actually active devaluation, it's merely pursuing what's dictated by the basket of currencies that it targets. So I think this is an important point because the whole discussion around Mr. Trump and China's currency manipulation is in fact a very, very false one. So finally, we come to my last chart, which is really another way of highlighting much the same sort of point. And this is the CFETS index, which is, in this case, the white line against the JP Morgan EM Emerging Market Foreign Exchange Index. And what one can see is, of late, basically, one is basically following the other. And in fact, what had actually happened was that the yuan had actually become quite overvalued relative to what was going on in emerging market currencies. So for the time being, I would not talk about, I want to be talking about Chinese devaluation, even if there is obviously some downside risk for the yuan, as long as the emerging market currencies come under continued pressure because of the outlook for the global economy. And that's it for this week.